Hey everyone, welcome back to Corporate Decoder. Today, OUST just filed a current report about a new sales agreement, and I am seeing a big picture shift the market might be missing. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is looking to raise up to $100 million, and we need to break down what that means and why it might be happening now. So on May 8th, 2026, Ouster Inc. entered into what they call a sales agreement. Think of this as a deal to sell their stock more efficiently in the open market. They brought in 4 different investment banks or agents to help them do this. What they are selling is their common stock, and the big news is they can sell up to $100 million worth of it. Now, they don't have to sell any of it, but they have the option to, and that is a significant amount of money. The agents, which are basically brokers, will work to sell these shares for Ouster Incorporated. They can do this through various methods, including what is called an at-the-market offering. This is a way for companies to sell stock directly to the public over time, often without a big fanfare. Ouster Incorporated will pay these agents a commission, which can be up to 3% of whatever they sell. To put that in perspective, if they sell all $100 million worth, the agents could make up to $3 million. This agreement is set up so either Ouster Incorporated or the agents can end it with a 5-day notice. This gives them flexibility, which is important in the fast-moving stock market. These shares are being offered under a shelf registration statement that was already approved, meaning the paperwork was mostly done beforehand. This allows them to quickly issue more shares when needed. They also filed a prospectus supplement on May 8th, which is like an update to that original filing detailing this new sales agreement. So what is this money for? The filing says it's for general corporate purposes, including working capital. Essentially, they need cash to keep the business running. Now let's look at the bigger picture and why this might be happening. Looking at recent headlines, Ouster Incorporated announced their first quarter 2026 results on May 5th, while their revenue jumped 49%. The company is still operating at a loss. This is a common situation for growth-oriented tech companies, but it means they constantly need to fuel their operations and growth initiatives. The stock price has seen some ups and downs lately, with a dip in April and then some recovery. They are a technology company focused on electronic components, and they have a market cap of around $1.6 billion with about 320 employees. Major institutional investors like BlackRock and Vanguard hold significant stakes. BlackRock has over 10%, and Vanguard has close to 9.5%. These big players generally don't like seeing their investments diluted without a good reason. The fact that they are filing to raise up to $100 million right after reporting earnings, even with revenue growth, suggests they might be looking to strengthen their financial position, perhaps to fund further research and development, expand their market reach, or maybe even to weather any potential economic uncertainties. It could also be a strategic move to have a war chest ready for opportunistic acquisitions, or to fund a larger growth phase. When a company, especially one that is not yet profitable, decides to sell more stock, it can put pressure on the existing shareholders. This is because selling more shares means the existing ownership pie is being divided into more slices, potentially diluting the value of each individual slice. It's like if you have a pizza and you suddenly decide to add more people to the party, each person gets a smaller slice. Think about similar situations. Companies that are burning cash and need to raise funds often go through these types of stock offerings. While it helps them stay afloat and grow, it can be a tough pill for existing investors to swallow in the short term. However, if the company uses this capital wisely to achieve significant growth and eventually profitability, the long-term impact can be positive. The main story here is that Ouster Incorporated is proactively managing its finances. They are not waiting for a crisis. They are securing the funds they might need to execute their strategy. The key will be how they deploy this capital. Will it lead to a significant increase in revenue and, more importantly, profitability? That's the question every investor will be asking. The risk I am watching is whether this capital infusion will be enough to push them towards profitability, or if it will be just enough to keep them going for a bit longer without a clear path to sustained profits. What I am actually looking for is a clear plan on how this $100 million will translate into a stronger financial footing and eventually positive earnings. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. If you found this breakdown helpful, hit that like button and subscribe for more. Join our Discord using the link in the description.